there certainly has been a lot for investors to try to digest between economic data and earnings over the course of this week and the past several weeks as the S&P 500 sees choppy price action over this past week. And while there is a slew of details for investors to weave through, here to break down some of the key themes for the markets, we've got Peter Tchir, who is the Academy Securities Head of Macro Strategy. Great to have you here with us this morning, Peter. Help us break down where there is perhaps an overweight in terms of the mind of investors, if it is on the economic data that they're seeing come out, which is a lagging indicator, or whether it is perhaps the leading indicator inclinations of publicly traded companies and their CFOs to say, this is the type of recession that we're baking in right now, and that's how you should kind of evaluate, or at least the lens that you can add on to everything that we're talking about with our forecast.
Yeah, and I think short-term we're headed more recessionary. I really do pay a lot of attention to what the corporations are saying. And what I think the market got caught in, and I've been calling it this pendulum, that we started way up here and the economy was great. The Fed is tightened and we're swinging down. And everyone made the mistake of seeing the data and saying, oh, we are in a soft landing. The data is very good. That was correct. I think the problem was people were expecting the pendulum to stop there, and it's going to keep swinging. Some of these job cuts, some of these layoffs, et cetera, that were announced are just coming through. And this is going to sound so simple that it's almost silly to even say, but my view right now is that one person's expenses are someone else's revenue. And every time I hear companies talk about cutting expenses, that's going to hit someone else's revenue. That's why I don't think this is done, and we're going to get a little bit of a recessionary problem here.
So, Peter, continue on in that vein, right? So where then are the second wave effects being felt from these expense cuts? What do you expect? You know, are you avoiding certain sectors, for example, where you think that's going to come to pass?
I think my best analogy, I guess, is this is going to be a little bit like 2014 to 16, where energy companies were hit and regions around energy were hit. This time it's going to be about big tech, semiconductors, et cetera. And I think what we're experiencing is we took 5 steps forward in that industry, and now we're going to take 2 steps back. Everyone needed web space. Everyone needed a big data plan. Everyone needed AI. And people are thinking about those now as costs are a concern. There was so much free money floating around for private equity companies that they could just invest in whatever they wanted. That's all stopped. So I think in 2 to 3 years, we will have more tech than we do today. But I think in 3 to 4 months, we might have less tech.
Peter, what do you make about the moves in some of these AI stocks?
You know, the one line I saw, I think it was maybe one of your accounts pointed out that most of the people who are now chatting about AI were talking about Web 3.0 a year ago. So yes, I think it's interesting, but I think it's hype. I think that we got to see where this plays out. It doesn't feel like the barriers to entry are that high. Clearly, we saw the other day, I think it was Google, their AI disappointed, and all of a sudden their stock got hit very hard. So too much is being built into AI right now.
What's the big idea to really kind of outplay the market performance right now, Peter?
So I think this is going to be a problem more for well-to-do people in the San Francisco area, people in and around big tech. I think at the bottom level, the bottom quartile of the country, jobs are actually good. Inflation is coming down. I think it's going to continue to come down. I think we see excess inventory that's got to get worked out. So I think they're going to see price pressures continue on retail goods. I think we had these services peak last year. I think that's going to come down. I think you had this wave of pent-up demand. So I think it's going to be a really good time for people who cater to that lower quartile of the economy. They are saving more money. They've got jobs if they want them. Those jobs are paying more than they used to. So I think that's going to be a really interesting growth path.
Peter, under this recessionary vibe call that you're talking about here, what's fair value for the S&P?
You know, I think at some point we are going to break last year's lows on the S&P and NASDAQ. I think in particular NASDAQ, we are going to go through that because everyone kind of got bullish again, and we're going to realize, oops, this is not as good. Consumers aren't spending as much as people thought. Companies are still overburdened. We're going to see that pressure point. So I like things like cable, telecom, things that people are going to need every single day. I think some of the excesses, some of the more, quote unquote, story stocks, they still have more room to fall.
Peter Tchir, Academy Securities Head of Macro Strategy. Always good to see you. Have a good weekend.
Thanks. You too.